Let's talk about escrow holdbacks when you're buying a home and technically refinancing too, but usually when you're buying a home, let's talk about escrow holdbacks and what it means, when to do it, when you shouldn't do it, and how it works. So an escrow holdback is typically used when somebody is buying a home and there are repairs that need to happen or improvements that need to be made. And the lender wants these to be done, but maybe just for whatever the circumstances are, can't be done before closing. So maybe it's the seller, maybe the seller is a bank, right? Of a home that got foreclosed on, and there are certain things that need to be fixed or updated, but the bank's going to say you're not touching the house. Like we don't want anything to happen while we own it, so you don't get access to it and can't do it. And maybe it's let's take a room without carpet, small room or something like that, and there's no carpet that's been pulled up for some reason. It's just that concrete. Well, an escrow holdback is this. An escrow holdback says, let's put the money that's going to be used to fix that thing, and we'll put it into a piggy bank. The title company will hold it after closing. And then when the work's done, that money then gets paid to the person who did the work. And so that way the mortgage company knows that this is taken care of. The money's already there and then they got it ready. So an escrow account, an escrow holdback is they're holding back funds to take care of something. So let's use this carpet example at closing. So this is not a home improvement loan. This is not a construction, remodel, renovation loan. Those are separate and those are different. They too will have escrows and things like that. But check out the link for more details. What I'm talking about is for minor things, really, really minor things. Dollar limit, I would say generically speaking, 5 grand or less. I know that some companies I've been at, make some exceptions up to 10 grand. I've seen some companies at 8. But just think for minor type stuff that can be done in a matter of a day or two, stuff that's not going to impact the structure or integrity of the house, the safety of the house, things of that nature. Those are typically not going to be it. So usually it's going to be like maybe there's paint, maybe some rotting wood, um, maybe some drywall, like just little type stuff, minor repairs that aren't going to be big deal, but do need to be addressed. So in my example, let's say that the cost is 4 grand. So somebody says, okay, there's no flooring in this thing. The lender does take objection because we want to make sure the house is pretty and put together, right? So in that example, we're going to say we need carpet or we need some type of flooring. And so the new future homeowner says, well, I'm going to put carpet in there. Cool. And they then go find their carpet guy, whoever they're going to do, and they say, hey, here's a $4,000 invoice to put in this carpet, this base, whatever. Here's the invoice for it. And we say, okay, fine. So at closing, what will happen is the mortgage companies will typically require about a 50% extra on top of the holdback, so a cushion. So in this example, if it's 4 grand at closing, they may require 6 grand be collected. The initial 4 to pay the contractor, and then a 50% buffer. And the reason being is they want to make sure if something happens, for whatever reason, in this example, not a lot can happen in a carpet, but let's say just for whatever reason, the carpet price went up the next week. We close and all of a sudden now it's $4,500. The lender wants to make sure there's enough money in that holdback account, that escrow holdback, to pay the general contractor when the work is done. So where does the money come from? So, well, the buyer in this example, if their bank says, hey, take it or leave it, the buyer may say, hey, I'll do it. Cool. Well, then 6 grand comes from the buyer. Now, let's say the work goes and get closed, the buyer owns the home, and within a few days, because you only have a few days to get this done, within a few days, let's say 2, 3 days later, the carpet's installed, everything's done, and the contractor will then say, hey, I now want my money, please pay me. The title company will be the one that cuts the check for, let's say it's exactly 4 grand, cuts the 4 grand check to the contractor. The title company now has an extra 2 grand that's just been sitting there. Well, if that's the case, they can then refund the excess money, and they got to get permission from the lender, but the money will then go back to the person that put the money in. So in this example, it was the buyer. So the 2 grand will go back to the buyer. So that is what an escrow holdback is. If the money, by the way, was put up by the seller, let's say in this example, Joe homeowner owned the land or owned the home, and part of negotiations was that Joe homeowner, sell the home and Joe pays for the carpet to get put in. In that instance, if Joe put in the 6 grand and it cost 4, the 2 grand would go back to Joe seller because they're the ones that put in the money. So that's what an escrow holdback is. Again, this is for minor stuff, minor repairs. There are certainly escrow holdbacks where that can be bigger for like swimming pools, but those are going to be different structures and different type of stuff. But this one's the quick and easy. But even on the pool, the big ones, the home improvement type stuff, Same principle. Money gets collected, gets held by the title company, a third party, and then the funds get dispersed as the work is done. That's what an escrow holdback is. So if you have questions, whether it's something for you or somebody you know, certainly reach out to the Mortgage Mark team. We are here to help. And as always, thank you for watching. And when you think mortgage, think Mark.